All right, here we are. We are live. Welcome to the live stream. Be the boss of your money. A couple of things to go over. I say this every day. We've got some big things to go over, but you know what? It seems every day we have big things to go over. First, let's talk about politics. They say don't talk. We're not ready for that yet. Politics and religion. Fed, not the Fed. Let's talk about the House of Representatives. Jim Jordan not drops, but says he is postponing his bid for Speaker of the House, while McHenry is offered possibly a temporary position as Speaker. But so many people are against that as well that we are back in the chaotic caucus, and we are waiting to see what happens. We've got another government shutdown to worry about in less than a month. So if you think the markets are rocky, now, just you wait and see how rocky they could get without a speaker, because we are going to start getting desperate. All right. We're going to roll the intro. I want to talk to you about how the determination of interest rate hikes is made, how investors read this, because there's something called the CME Fed Watch tool. We talk about it all the time. You hear about it in financial media, but I actually want to show it to you so that you can get a better understanding of exactly what it is that we're talking about. Here's the intro. First afternoon coffee. It's 5:01 right now. Does that mean, speaking of 5, we didn't hit 5% yet on the 10-year Treasury, but we're on watch. If it's afternoon coffee at 5 o'clock, does that mean we should call it afternoon coffee? I'm a coffee drinker, and it does not keep me up, luckily, but it's good. Coffee is wonderful. So we talk about the Fed. Well, we talk about the CME Fed Watch tool a lot. You hear about it in financial media all the time. I actually want to take a moment to show you exactly what it is that we're looking at, why it's important, and now you'll have a better understanding of exactly what this tool is. So let's put this up on the screen. Of course, I have my cell phone exactly where my mouse would go, so that just like threw me off. Okay. All right. Let's go over here. I'm going to make this a lot bigger. You can see that, right? All right. This is from the CME Group.com, CMEGROUP.com. You could look it up for yourself, or just Google CME Fed Watch tool. This is telling you 12 days, 20 hours, and 56 minutes and some seconds until the next FOMC meeting. The FOMC is the Federal Open Markets Committee. So when you hear that the Fed is meeting, the Federal Reserve is meeting to discuss its interest rate policy, what they really mean is the part of the Fed that meets to talk about interest rate policy every 6 weeks is the FOMC, Federal Open Markets Committee. And what it's telling you is that the next time the Fed could raise rates in November, you just pump this down. All right. November 1st. All right. The Fed meets October 31st and November 1st. If it's a 2-day meeting, the Fed decides what it's going to do with interest rates the second day. So about 2:15 November 1st, we'll get the announcement that we expect that the Fed decided to leave interest rates alone, that inflation is still too high. They're being vigilant, but for now, they want to let the past rate hikes do their job, and we'll wait for incoming data dependent. So we take this and we see that There is a better than 99% chance, according to market participants, people who watch this for an actual living, like me, and we're saying that there's no shot that the Fed raises rates at all. We expect the Fed to stand pat on the next meeting. And then the next time is December 13th. And there is about a 75% chance that the Fed does nothing. So only about a 25% chance, less than 25% chance that the Fed raises. And then we start to go into different meetings. And by the time you get to May, we start to see that there's more of a chance that the Fed could raise rates than leave them alone. So that's what we're looking at. But then you go all the way out to September of 24. And what you have to see is that you see this. This is where rates are right now. There's a shot 30, 46, 50. There's a better than 50-50 odds that the Fed is going to start cutting rates by the time we get to the latter half of next year. And that's because it's expected that the economy will slow down sufficiently to bring inflation down to the Fed's 2% target rate. And in which case, you'll see the employment picture worsen, unemployment goes up, corporate earnings start to suffer, and you'll see other problems with that a slowing economy could bring about. But then again, analysts are expecting corporate earnings to be pretty good also. So there's just so many conflicting news. But that's the CME FedWatch tool, and it is subject to change and often does depending on the data that comes out. Let's take a look at Tesla and Netflix. These are the two big important movers today. We can make this a little bigger. All right. All right. This is Tesla. Go by this number over here. Tesla was down $22.50 in trading today, down over 9%. It's down another $2 in aftermarket trading, while Tesla is up $55, up 16%. So definitely a case of the haves and have-nots. Tesla missed big on numbers, didn't have a great forecast going forward. A couple of analysts have written them off and said their story is over, they're toast. And their CEO, Elon Musk, was pretty tempered in his comments of expectations for the new vehicles, in particular the Cybertruck. But every time analysts count Tesla out, they come out with something incredible or come out with incredible news. People get excited again, and then the bulls come back into the stock. So this is always a battleground stock, and I look at this more like a trading vehicle than I do as a investment. That's my own opinion. Netflix cracked down on password sharing, and as a result, more and more subscribers are coming to Netflix. And they came out with a free subscribership with ads. It's ad supported, but it's doing very well. And it turns out people would rather have ads and free than premium and no ads. So Tesla had a huge rally. The stock had been sold down a lot. But if you look where Tesla is, you see this line over here. That's the left, the green 101 to 299. That's the 52-week high and low. Tesla's come down a lot since hitting that $300 mark. And even though Netflix was up quite a bit today, they're still down a lot from their high too. So when people say that the market is being held up by a handful of stocks, that handful of stocks is holding up the market, has been giving up the ghost, and other stocks are starting to, maybe, there's another 10 stocks after the top 10, they're starting to do a little bit better. But the market seems to be doing okay without the support of its magnificent seven. I'm not saying that it was down 300, down 250 today. I'm not saying it's not going down, but I don't think it's so accurate anymore to say it's all about the top 7 stocks in the S&P 500. Okay, so the S&P 500 is an index. You know what I'm going to say, but I have to say it. You can't invest directly into an index, but you could invest into a security that tracks or mimics an index. Let's take a look at a crazy, wacky headline. I'm not saying it's crazy, wacky, except for that it's very hyperbolic. S&P 500 to mount relief rally to new record before year end, says Piper Sandler, chart analyst. Maybe the market could rise another 14, 15% by the end of the year. Now, keep in mind, we have less than 2.5 months of trading left to this year. You strip out Thanksgiving, you strip out Christmas to New Year's Eve, vacation time. We have about 2 months left to mount anything serious in the market. And I think we would have to see the Federal Reserve start to talk about not raising rates anymore and, in fact, holding steady with the intent to eventually cut. That would all have to happen by the end of this year. I think it's a very tall order. And on the scheme of possibilities, well, anything can happen. But to me, to my experience of over 30 years as a financial advisor and following markets and commenting in the national media about markets, it's a tall order. And if you need the stock market to rally to a new all-time high by the end of the year, you're probably so far behind the 8 ball in your financial goals that no amount of market gains over the near term are going to help you. So let's not get carried away with hyperbolic titles. I've seen some that says the market is due for a 20% crack near term. Maybe, maybe not. Should you adjust your plans, your financial plan, and your investment plan to accommodate a prediction of whether or not the stock market could be up something like 20% up or down in the short term, meaning 6 months or less? Should you do that? Because the extremes do happen, and they're notable. Every couple of years, you get the extremes. Sometimes it's more than every couple of years. It takes a long time. But overall, the extremes typically go away. They typically get washed out over time. And usually you don't get extremes. I don't change or make bets on extremes that could be possible. And I think that's how most investors are. Certainly my clients are like that. We're investing with goals in mind. We are investing with a purpose. We are looking at different asset classes. Sometimes bonds become more attractive. Sometimes bonds become more attractive. Sometimes stocks become more attractive. But over time, the relationship between volatility, interest rates, and time, whether you're talking about stocks or bonds or cash, have remained roughly the same for the past 70 or 80 years. And that is a trend that I think is worth betting on, that it continues, rather than trying to decide on when we're going to hit some extreme in the market, evaluation popping or going up like a rocket ship. And then I think you'll be better off. That's how we do it. And we don't make changes that are hasty. All right. So let's take a look at the rest of the market. Put myself up here. So the Dow down 250, continuing downtrend of this week. NASDAQ down 128, S&P down 36. None of the indexes exceeded being down more than 1%. Did I say you can't invest directly into an index, but you could invest into a security that tracks or mimics an index? I think I did. Gold, yeah, I did. Gold up 18. Gold is starting to catch a bid finally. It's a stone's throw from 2,000. We'll see if it can hold on to it. Typically, gold hits 2,000. People get excited for about a week, and then it goes back down. Oil is also going up. And this can only be blamed, I think, not really on rising demand. I think it's really more of a worry that the Israelis have said they are determined to keep the fight going and against Hamas. And the longer it goes out, the longer it drags on, the higher oil is going to go. How any country like Russia could come out and knock Israel for you're going into civilian areas after what Russia did in Ukraine and Georgia and other countries. The hypocrisy, and it just goes to show you authoritarian ruled groups, societies, countries eventually fall apart. Someone told me, someone said to me, it's kind of a debate. We're talking about the BRICS countries and they're using their own currencies and how that's a threat against the US dollar. And the person who was speaking was this geopolitical strategist who worked for one of the mutual funds. I can pretty much tell you that this person seemed to be winging it. And as she took her cues from the and as she took her cues from the audience, I felt like she was just saying what the audience wanted to hear. Ooh, BRICS bad, competition to the dollar. She goes, that's right. There's going to be a lot of competition to the dollar. And I raised my hand a question. I said, why do you say that? If don't you need a deep bond market, a deep sovereign debt market, like a deep treasury market for the United States, to have a deep currency market? She's oh yeah, you do. She had no idea what I was talking about. And then somebody else said to me, well, Mitch, we used to use the gold. Like somebody's trying to mansplain me like the gold standard. Like, what an idiot. So anyway, no, the dollar is not being threatened. Russia has no economy. Brazil has nothing much to speak of. China is imploding, severe population demographic problem. Their economy has been completely based on exports and the desire of the developed world to export their manufacturing and production of cheap goods overseas. That's all changing. Even the China Belt and Road project is starting to look like a bust. Countries in Africa and Southeast Asia borrowed way too much money to pay for the projects that were built for the Belt and Road project that China, by the way, is on the hook for because China is the country that loaned the money. China's not very good at lending money to other countries, by the way. They just don't have a good underwriting department, I guess. But even as countries start to change who they trade with and as global trading becomes more based on regional trading, it basically destroys the desire for anyone to be in the Belt and Road project. A lot of things going on, a lot of geopolitical things changing. A lot of this has to do with the magnificent shale oil discoveries in North America. All right, so that's about it. Oh, yeah, we didn't talk about interest rates. So let's just talk about interest rates real quick. And then I'm going to let you go. All right. Let's see. I'm going to make my screen a little smaller so I could show you what I'm looking at. Let's look at the bond market first. Let me take a look at interest rates here real quick. Just stick with me 1 second. I'm just setting up the screens so I could show you exactly what I'm looking at. Because what I'm going to show you is basically everything that this whole market is about. Everything you need to know in two screens. Okay, I'm going to show you everything you need to know right now about the investment world in just 2 screens. First one we're going to look at is the 30-year mortgage rate. 30-year mortgage exceeding 8%. It hit it this morning, slightly above 8%. People say it's a cataclysmic event. People have been saying for months, if we hit 8%, that's it. It's all over. I want like, what's all over? Well, they say it's all over. Who's they? What do you mean it is all over? What do you mean by it? The economy? The housing market? The difference between mortgage rates from 2 or 3 days ago and today is not even worth mentioning. If 7.98% versus 8.03% makes a difference for somebody getting a mortgage, that person is probably doing something wrong and they shouldn't buy a house or borrow money to begin with. So having said that, mortgage rates are above 8%, and it just puts further slowdown and pressure on the housing market, which does impact the overall economy. We're all wondering, where are we going to get a slowdown in the U.S. economy? And it looks like anything tied to housing will probably hit first, and then we'll start to get a rise in unemployment, meaning you'll start to see less carpet manufactured, less appliances, less stuff being sold at Lowe's and Home Depot. And then you'll start to see some knock-on effects in the overall economy. And then inflation will come down a little bit more. And then the Fed will say, okay, that's enough. We're going to start to stimulate and lower rates. The other rate I want to show you is this one. This is the 10-year Treasury. It didn't quite hit 5% on its high. 4.93 in the regular session. Right now, 4.99. And we've been watching this for weeks. After it hit about 4.5, I said the next step is going to be 5%. That's what people are going to watch out for. We like our round numbers, 4.0, 4.50, 5.0. We like our round numbers. We haven't seen it yet, but once we see it, it'll be a big news blast. It'll be all over the place. And then we'll get back to worrying about what the Fed's going to do. The upside, though, is that the yield curve is much less inverted. And it's possible that the yield curve, with any relief in short-term rates, the yield curve could go back to being normalized again, which will be taken as a positive sign that the economy is getting ready to get stronger, but we have a lot of work to do. So usually what happens is the economy gets weaker before it gets stronger. We haven't had the massive weakness in the economy or the massive drawdown that lasts in the stock market yet to really feel like we're in a recession and a severe bear market. And some say we need to get there. Some say we won't get there because we're going to have a soft landing, meaning the economy is going to slow down without hitting a recession. All of this remains to be seen. I wish I could tell you what's going to happen. You ask enough people, you'll get enough opinions that you'll be thoroughly confused. And that's why I think the best thing to do is invest and plan based on your needs, your goals, your time horizon. Those are the inputs, and control what you could control. All right, that's about it. Have a great day, guys. I'll see you. I'll be back Monday because tomorrow's Friday. I usually do this live stream Monday through Thursday. If anything happens tomorrow that's crazy, I'll definitely be back on. Thanks, and don't forget to give us a thumbs up.